Okay, let's unpack this. If you've been feeling like the market and the global economy are stuck somewhere between holding your breath and bracing for impact lately, you are definitely not alone.
Hmm.
There's this, pervasive sense of uncertainty right now, isn't there?
Yeah, absolutely.
The report we've been digging into describes it perfectly, actually, as being comfortably uncomfortable.
That phrase really resonates because, well, it captures that state where things aren't necessarily bad right this second, but the future feels, I don't know, less predictable than it has in a long time.
Exactly. And that's why we decided to do a deep dive into this specific mid-year outlook report. It looks at how experts are thinking about navigating this whole environment as we hit the middle of 2025.
Right, and the report's very clear about its purpose.
Mhm.
It poses 5 essential questions. These are designed to help unlock opportunity in this uncertainty.
Okay.
So our goal today is to take you through those questions, pulling out the most important insights and specific points directly from the source material.
Yeah.
We want you to finish this feeling like you have a much clearer picture of what the experts believe is most crucial to understand right now.
So these 5 questions are kind of the lenses the report uses to look at the current landscape. They cover everything from, the potential impacts of a Trump 2.0 presidency, how to build a resilient portfolio, which is key, the big debate around the future of the U.S. dollar,
Yeah, that's a big one.
why maybe we aren't hearing as much about AI as we perhaps should be, and finally, what's really happening with deal making in this environment.
They are definitely the topics that seem to be top of mind for, well, anyone trying to make sense of where things are headed.
All right, let's jump into that first question then. It's a big one, and it ties right into the political landscape. Should investors cheer or fear Trump 2.0?
Yeah.
The source notes that the initial market expectations, which were generally leaning sort of pro-growth, investor-friendly right after the election, well, they haven't quite played out as expected.
No. The pain, as the report puts it, kind of arrived earlier than anticipated.
Right. And the biggest single source of that pain, the main driver of investor unease, according to this report, isn't necessarily broad policy, but something quite specific. Tariffs.
Tariffs, yeah, that's what they pinpoint. The source views these tariffs as signaling a pretty abrupt and potentially chaotic reversal of that whole post-World War II trend toward free trade.
Hmm.
And importantly, the report emphasizes that all else equal, tariffs are generally not good for the economy or for corporate profits.
Right. They tend to lead to slower growth, higher prices for consumers, and lower corporate profits because, well, companies have to absorb costs or pass them on. Simple as that, usually.
And what's striking here is the scale the report points to. They estimate the U.S. effective tariff rate is likely to settle somewhere in the mid-teens.
Mid-teens, wow.
Yeah, and this is highlighted as the highest level we've seen since the Smoot-Hawley era back in the 1930s, which is, synonymous with high protectionism.
And to put that scale in perspective, the report estimates today's proposed tariffs are nearly 4 times larger as a share of GDP compared to the 2018 trade war levels.
4 times.
The source even labels this potential impact as one of the largest non-wartime tax hikes in U.S. history.
That's a strong statement.
Yeah.
And they explain that while companies had some ability to adjust back in 2018, maybe shifting suppliers or raising prices a bit.
Yeah, there was some wiggle room.
That's much tougher now because the proposed tariffs are broader, potentially impacting a wider range of goods and trading partners. And crucially, a potential global trade war increases downside risks significantly compared to just a dispute with one country.
Ah, okay.
The report uses the Canada example to illustrate this. Canada's exports to the U.S. are 20% of their GDP, making them highly dependent.
Right.
Whereas U.S. exports to Canada are only about 1.2% of the much larger U.S. economy. That gave the U.S. leverage then. A global fight is, it's different.
So the U.S. vulnerability shifts when it's a broader trade conflict, which the source suggests might help explain why non-U.S. assets have seen some outperformance compared to U.S. assets recently. Makes sense.
The report also gets pretty specific about the potential economic impact of these tariffs.
Yeah.
It states that if tariff rates were to remain at their highest initial levels, the ones seen on April 2nd, what they call Liberation Day,
Okay.
it would likely tip the U.S. and global economies into recession. However, and this is important, their base case is that if they settle in that estimated mid-teens range,
Right, the mid-teen.
the source believes the U.S. economy can still manage slightly positive growth and see mid-single-digit corporate EPS growth over the next 12 months.
Okay, but just to be absolutely clear here, We are reporting the source's analysis. We're not taking a political stance or endorsing any specific policy ourselves.
Absolutely not. Just presenting what the source's analysis concludes based on their models and data.
Got it. Okay, beyond tariffs, the report points to other domestic factors contributing to the economic picture. They mention government spending cuts orchestrated by something they call DOGE, essentially significant cuts to specific programs which have already led to over 275,000 layoffs, according to the source.
Yeah, that's a big number. They also highlight a significant 80% decline in net immigration from the 2023 peaks, which obviously has implications for the labor force and maybe economic growth potential.
Right. And then there's potential uncertainty coming out of Congress.
Always.
They're apparently contemplating a tax bill that could add nearly $6 trillion to the budget deficit over 10 years.
$6 trillion. Wow.
Yeah, and the source emphasizes the scale of this by pointing out this increase would be larger than the original 2017 Tax Cuts and Jobs Act, the CARES Act, the American Rescue Plan, and the Infrastructure Act combined.
That really puts it in perspective. It's huge.
It is. The report notes that equity investors might view this deficit increase differently than, say, fixed income investors.
Natural.
And there's also uncertainty about whether there will be corresponding spending cuts, like potential reductions in Medicaid, or rolling back parts of the Inflation Reduction Act to maybe offset some of those tax cut costs.
But what's a fascinating counterpoint the report offers is the impact of deregulation.
Ah, okay.
While the big legislative moves are uncertain, they argue deregulation is quietly having a positive impact, particularly on the banking sector, and suggest investors might be sort of underestimating these benefits.
And here's where that gets really interesting from the source's perspective. They point out that large U.S. banks have built up over $200 billion in excess capital.
$200 billion, that's a lot of capital sitting there.
Beyond their current regulatory requirements. So if capital rules are softened, that significant chunk of capital can be deployed.
Right.
The source notes this could fuel private sector loan growth, which U.S. Treasury Secretary Besson has apparently prioritized, and potentially boost share buyback.
Yeah, they used the Goldman Sachs Q1 example,
Yeah.
where the plan was worth like 26% of its market cap.
Huge. And it could also encourage banking sector consolidation through M&A.
And they point to the recent approval of Capital One's purchase of Discover as maybe a positive signal that banking M&A could pick up.
Okay.
So the source believes bank stocks could benefit in the second half of 2025 if the focus shifts towards these types of potentially pro-growth policies.
Interesting angle. The report also asks if tech stocks will get a second wind, because tech and the Mag 7 stocks, they've underperformed recently.
They have.
The tech sector was down over 8% and the Mag 7 down over 12% year to date as of early May when the report was being finalized.
But the source sees potential here too. They highlight strong underlying earnings growth forecasts. The Mag 7 is expected to deliver 15% EPS growth in 2025 compared to maybe 8% for the rest of the market.
Okay, so the earnings are still there.
Yeah, and despite high absolute numbers, valuations relative to the rest of the market are actually at their lowest levels in 10 years.
Really? Lowest in 10 years.
Relatively speaking, yes. And the semiconductor industry's specific exemption from proposed tariffs is also viewed as a positive signal by the source.
Ah, that makes sense.
They argue it highlights the U.S. comparative advantage in tech innovation, which, it would be strategically unwise to erode with tariffs.
Right. So pulling it all together for that first question, cheer or fear? What's the bottom line from the source?
Well, their view seems to be that the tariff uncertainty does create significant near-term pressure. It impacts growth and corporate profits for much of the coming year.
Okay.
But they don't believe it necessarily derails the bull market entirely. They see the possibility of other, more investor-friendly policies, like maybe lower rates down the line, potentially lower energy prices, and less regulation emerging more clearly in the second half of 2025.
So a bit of a balancing act.
Exactly. And despite the potential for choppy markets to continue for a while, the report's conclusion is that key developed market equities, the U.S., Europe, Japan, are still expected to make new highs over the next 12 months.
Climbing that wall of worry, as they say.
That's the phrase he used, yeah. Climbing that wall of worry.
Okay, that gives us a really detailed picture on the political and immediate economic landscape, according to the source. Let's move to the second big question from the report, which tackles portfolio strategy. Is your portfolio resilient to growing risks?
Yeah, and this question is crucial because, as the source highlights, we've clearly entered a different market regime compared to that post-global financial crisis era, roughly 2009 to 2020.
Right, that period was all about low inflation, low interest rates, relatively low volatility, smooth sailing, comparatively.
Exactly. Portfolios that performed well then might need some adjustments now.
Because now, as the report points out, we're navigating a world with two-way risks for both growth and inflation, alongside just persistent policy uncertainty.
It's a regime shift, yeah,
Yeah.
with meaningful implications for how you build resilience.
So what does the source actually mean by a resilient portfolio in this new environment?
They define it as one that includes assets with low or negative correlations to each other, assets that can outperform cash, and collectively help mitigate the severity of portfolio drawdowns during market stress. The report still emphasizes, though, that core fixed income remains a key asset for resilience, specifically in a growth downturn scenario.
Got it. So core bonds still play that traditional role. What other assets do they identify as attractive for adding resilience right now?
Well, first, for qualified investors, they point to equity-linked structured notes.
Okay, structured notes, how do they help?
The report suggests these work well in the current environment because they often pay a coupon linked to factors like implied equity volatility and interest rates.
Tapping into that higher vol rates.
Exactly.
Yeah.
Why is that relevant now? Because both are expected to remain elevated, meaning these notes potentially offer better downside protection or maybe higher coupons than some traditional instruments. They can provide income that's uncorrelated to core fixed income and maybe offer higher return potential with a narrower range of outcomes compared to assets like preferred stocks or high-yield bonds. They actually note they're seeing twice as many clients using these structures this year compared to last.
Interesting. So demand is picking up there. What's another option they highlight?
Hedge funds are presented as another option, again, for suitable investors.
Right.
The source shares a pretty compelling statistic. From December 2019 through August 2024, nearly 80% of randomly generated hedge fund composites outperformed a simple stock-bond mix on a risk-adjusted basis.
80%.
Yeah. They offer low correlation to core fixed income, and the current environment, elevated valuations, uncertainty, creates market dislocations that specific strategies within hedge funds, like relative value or macro strategies, can potentially capitalize on.
Okay.
The report also argues they can deliver better after-tax returns over longer periods than maybe is often assumed.
Got it. And infrastructure investments, how do they fit in?
Infrastructure is highlighted for its resilience due to long-term contracts, which often have inflation protection built in, pretty valuable in a world where inflation risks are two-sided.
Yeah, definitely.
The report points out that over 40% of the historical returns from infrastructure investments have actually come from income, which could be attractive.
Steady income stream.
Right.
Yeah.
And there's also significant demand driven by secular trends, like the need for new power generation, digital infrastructure, plus the growing need for more resilient infrastructure because of climate shocks.
That makes a lot of sense. And finally, they include gold in this list.
Yep. Gold is positioned as an asset that can offer protection against geopolitical risk and potential dollar weakness, which, we'll touch on more in the next question.
Okay.
The report highlights the significant disparity in central bank gold holdings. Countries like the U.S. and Germany hold over 75% of their reserves in gold,
Right.
while others like Saudi Arabia, China, and Japan hold less than 7%. Big difference.
Interesting comparison. Now, on the flip side of assets often considered for diversification, the source expresses some skepticism about crypto.
Yes, the report is quite clear here. Despite their low correlation to traditional assets, the source is skeptical that Bitcoin and other crypto assets actually improve portfolio resilience for most investors.
So, not a resilience booster in their view.
Not really. They cite historical evidence suggesting crypto has actually made portfolios more fragile due to its extremely high volatility and significant drawdowns.
Right. Those drawdowns can be brutal.
Yeah, the report even includes a chart showing Bitcoin's drawdowns are just dramatically steeper than a diversified portfolio or even global equities.
Okay. So while crypto has its advocates, the source's analysis based on historical data suggests it adds fragility rather than resilience. The report also mentions some foundational steps, kind of basic portfolio hygiene.
Exactly. This gets back to fundamentals. Simple things like addressing portfolio drift.
Yeah, the silent killer.
Right. A classic 60% equity, 40% fixed income portfolio from just a few years ago, say 2020, will have likely drifted toward something closer to 75-25 today.
Just because equities did so well.
Precisely. Due to equity outperformance. So if your intended allocation is 60-40, you've drifted significantly off target. And given the strong performance of U.S. assets, many portfolios are now overly concentrated in U.S. dollar assets.
Which, as you said, leads perfectly into the next question. But before we get there, the source really emphasizes that thinking about resilience now, actively managing for drift and concentration, and considering these potential asset choices. It isn't just academic.
No, it's crucial for staying on track with your long-term wealth goals, no matter what the unpredictable markets decide to do next.
It's about building a structure that can weather a wider range of outcomes than maybe one designed purely for that previous low volatility regime.
Exactly. Building for the environment we're in, not the one we're in.
Okay, on to the third question, which directly addresses one of the big macro debates right now. Is this the downfall of the US dollar? The dollar has seen some declines recently, and that's certainly sparked a lot of discussion. Is this, an existential threat to its reserve status or just a shift?
Well, the source leans strongly towards the latter. They see it as a potentially significant shift or maybe a slow erosion, but not a sudden collapse of its status as the world's primary reserve currency.
Okay, so not panic stations yet.
Not panic stations.
Um,
They outline the core reasons the dollar has held this position for so long: the largest and arguably most stable economy, the deepest and most liquid financial markets,
Right.
a strong rule of law and institutions, consistent policy regimes, at least historically, and that perceived security backbone provided by the U.S. military globally. All those factors matter.
They do acknowledge the historical context, though,
Mhm.
that past reserve currencies like the Spanish galleon and the British pound eventually lost their primacy.
Oh, absolutely. History is clear on that. And the report does suggest the dollar seems to face more potential downside risks now than it has in decades.
So what are the main drivers of that risk, according to them?
The source points to two main drivers for the dollar's recent weakness and future risk. One is the tariffs and trade policy uncertainty we talked about in Q1.
Right, disrupts trade flows.
Exactly, disrupts global trade patterns priced in dollars. The other is growing concerns about the U.S. fiscal outlook and the ballooning budget deficit we also touched on.
And this is where the source uses a rather provocative analogy.
Yeah, they do. They express concern that U.S. policymakers could repeat mistakes seen in other countries over the years, specifically using the term Peronist mistakes,
Okay.
referring to policies often associated with protectionism, less central bank independence, and maybe a disregard for macroeconomic stability in favor of political goals. And rather ironically, they note this concern about U.S. policy is happening just as many Latin American economies who experienced similar policies in the past have actually made substantial progress in establishing more stable, market-friendly frameworks.
And again, just highlighting, this is the source's specific view and analogy they're using.
Correct, their analysis. But despite that concern about policy direction, the source still leans towards a more subtle erosion of the dollar's value over time rather than a sudden collapse.
Because of the network effects.
Exactly. They emphasize the immense power of network effects. It's incredibly difficult and disruptive for countries, companies, and investors to just switch from a currency as dominant as the dollar. It's sticky.
And those dominance numbers are pretty striking. The source points out the dollar makes up, 60% of foreign reserves globally?
60% foreign reserves, 65% of international debt is denominated in dollars, and nearly 85% of SWIFT trade settlements still occur in dollars.
85%. Wow.
Compare that to the euro, often cited as a potential competitor. It accounts for just 6% of SWIFT settlements. Big gap.
That really shows the scale of the dollar's embeddedness in the global financial system. However, market perception is shifting, right?
It is. The source highlights survey data showing nearly 70% of investors believe the dollar is overvalued,
70%.
and a net 61% expected to depreciate. That's the highest share expressing that view since way back in 2006.
Okay, so sentiment is definitely leaning towards weakness. What's the report's outlook for the dollar's value in the nearer term then?
Their base case is that the dollar loses a few more percentage points by year-end, with risks tilted to the downside.
A few percent, okay.
Yeah. And while that's not a collapse, they do note historical precedent suggests sustained dollar weakness can lead to significant depreciation over the longer term, maybe around 40% over a 5 to 10-year period.
40% over 5-10 years, that's significant. So if the risk is an era of dollar decline, how does the source suggest investors mitigate that potential impact?
Currency diversification is key. That's the main message. The source favors the euro, the Japanese yen, and gold for diversification,
And why those specifically?
citing their size, liquidity, historical reserve roles, and importantly, lower correlation to global growth trends compared to the dollar.
Okay. For U.S.-based investors, one of the more straightforward ways to get this exposure is through euro and yen-denominated equities, I assume.
That's right. The source's long-term assumption is that U.S. dollar depreciation could add a meaningful 1% to 2% annually to total returns for European and Japanese equity investments for U.S. investors.
Just from the currency tailwind.
Exactly. Just from the currency translation tailwind over the next 10 to 15 years.
It adds up.
It does. They also note that private equity investments offer inherent geographic and currency diversification. Since U.S. equities make up maybe 70–75% of major public benchmarks, but only about half of global buyout volumes happen in the U.S.
Good point. Diversification built in.
But they add a crucial caution on unhedged foreign bonds for U.S. investors.
Yeah, okay. What's the risk there?
Well, they found that a U.S. dollar-based investor in an unhedged ex-U.S. aggregate bond portfolio experienced almost twice the volatility of a U.S. domestic bond portfolio over the last 20 years.
Twice the volatility.
Yeah.
Just from currency swing.
Yeah. Currency swings can dramatically increase bond volatility if you don't hedge, so caution is advised there.
That's a really important practical point for investors thinking about diversifying their fixed income. The source also mentions a specific, maybe less common metric they track to assess market perception of U.S. credibility.
Yeah, this one's interesting. It's the percentage of trading days when stocks, bonds, and the U.S. dollar all decline simultaneously.
Kind of a confidence crisis indicator.
Sort of, yeah. They compare the U.S. situation where this happened on about 7.5% of trading days over the last 3 years, but notably only 5% year-to-date in 2025, despite all the recent noise.
Lower recently, then.
They compare that to countries like Brazil, where it's over 20%, and the UK, which they cite as the most troubled developed market on this metric. So the U.S. number is still relatively low, suggesting market perception hasn't completely crumbled yet.
Right. So their conclusion on the dollar is its status isn't going to vanish overnight, but there is an elevated risk of entering an era of gradual decline.
Exactly. Investors have time to understand this potential long-term shift and take steps to position their portfolios accordingly. It's about anticipating the direction of travel, really.
And planning for a world where the dollar isn't quite as dominant as it once was. Okay. All right, let's shift gears to the fourth question. And honestly, this one surprised me when I first read it in the report. Why isn't anyone talking about AI anymore?
Yeah, it's a great question. The report makes the case that the uncertainty around tariff policy and other macro headlines has really overshadowed what they see as a major and, frankly, accelerating secular trend.
It does feel like AI was the topic for a while, and then it got quieter.
It did. And the report highlights that even before the big tariff announcements in April, AI-linked stocks had experienced a notable wobble during the market sell-off back in March.
Okay.
They point out that nearly 2/3 of the 20 companies that accounted for 80% of the S&P's losses during that peak-to-trough period before April 2nd were actually companies significantly exposed to AI.
2/3. Wow. So AI stocks led that mini correction then.
Largely, yes. And the specific catalyst for that March wobble, according to the report, was something they call the DeepSeek moment.
DeepSeek, what was that?
This was when a Chinese startup launched a new AI model that dramatically challenged previous assumptions about the cost, resources, and performance needed to develop high-performing AI models.
Ah, so disruption from an unexpected place.
Exactly. The key insight was that DeepSeek could achieve significant results at a much, much lower cost than previously thought possible.
Okay, and that caused jitters.
It did. This development immediately led investors to question whether the major hyperscalers, companies like Amazon, Microsoft, Google, Meta, that provide the cloud infrastructure for AI, whether they'd continue their aggressive capital expenditure plans building out that infrastructure.
Right. If it gets cheaper, do you need to spend as much?
Precisely. And critically, it raised questions about when those massive investments would actually start paying off.
But the report notes the hyperscalers' response has basically been full steam ahead, right?
That's what they say. Full steam ahead. In fact, Wall Street analysts are now forecasting nearly 33% capital expenditure growth for the 4 major hyperscalers in 2025.
33% growth, that's huge.
And that's actually an increase from earlier estimates of just over 20% at the start of the year. So they're doubling down.
Wow. So despite that temporary stock wobble, the source expresses pretty high confidence that AI will indeed catalyze substantial productivity gains across businesses and the economy.
Very high confidence. Their key piece of evidence for this is the dramatic reduction in cost and the simultaneous improvement in capability. Large language models, for example, can now deliver what they call PhD-level outputs.
Impressive.
And their costs have declined dramatically by somewhere between 80% and 99%.
80 to 99% cost decline. That's an incredible collapse in cost for such a powerful capability.
It really is. And the report uses historical analogies to underscore the potential impact. Technologies like the Bessemer process for steel, the advent of air travel, PCs and semiconductors, mobile phones,
Or big game changers.
all saw rapid, widespread adoption after dramatic cost declines made them accessible. They see AI following a similar path.
So the source sees the AI race at a really interesting juncture right now.
Yeah, a fascinating dynamic. The leading research labs are still heavily incentivized to invest and compete aggressively to develop ever more capable, maybe even self-improving models. But simultaneously, that very competition is driving prices for existing capabilities lower and lower, which in turn encourages wider adoption across more companies and applications. It's a virtuous cycle, potentially.
And the report predicts that the next wave of software applications will be dominated by something they call agentic AI.
Agentic AI, yeah.
Yeah.
Essentially programs that can operate with a much higher degree of human-like intelligence, independence, and the ability to complete complex tasks autonomously. Think AI assistants on steroids.
Okay. And the potential scale of the opportunity here, the total addressable market, or TAM, the source thinks it's massive.
Massive. They compare the potential TAM for AI to previous tech transitions like cloud computing and mobile.
Huh.
In the 2010s, those transitions created over 30 publicly traded companies with over $1 billion in annual revenue.
Wow.
And accounted for over $1.9 trillion in public market capitalization.
Trillion with the T.
Right. The source believes AI's potential TAM could surpass both of those, largely by targeting the significant cost base associated with employee compensation, basically making workers way more productive.
Of course, whenever people talk about AI, especially with those kinds of huge numbers, the specter of the dot-com bubble inevitably comes up.
It always does. And the source addresses this directly. Skeptics draw parallels to the excessive valuations and, let's be honest, often inadequate business models seen before the dot-com crash in 2000.
Right. Is history repeating?
Well, the source rebuts that current AI capital expenditure levels and stock valuations do not yet suggest a bubble in the same way. CapEx, for instance, is largely being financed by existing cash flows or maybe modest debt, not excessive equity issuance like we saw in 2000.
Okay, so the funding source is different.
Right. However, they acknowledge they are closely monitoring for whether these massive investments deliver sufficient payback, and they're also watching for pockets of froth, particularly in areas like, say, data centers.
Got it. And recent earnings reports from some key players seem to support the source's confidence in the underlying demand.
They do. For example, AI demand contributed nearly half of Microsoft's cloud units' 35% growth last quarter.
Half. That's significant.
And Microsoft processed over 100 trillion AI tokens in Q1 alone. That's a 5-fold increase from just a year ago. The demand is clearly exploding.
Okay, so the source is focusing investment on the companies and sectors poised to benefit from these cost savings and productivity gains, like software, financials.
Right, and those developing promising agentic applications. They also emphasize that exposure to private markets is crucial for accessing the full scope of AI expansion.
Why private markets specifically?
Because only around 4,000 of the nearly 100,000 investable software companies out there are actually public. The vast majority are still private.
That's a huge discrepancy.
Yeah.
So the conclusion on AI from the source is clear. People absolutely should be talking about it.
Yes. It's an accelerating high-impact trend, driving significant productivity gains and earnings potential, despite being temporarily overshadowed by macro and political headlines. It hasn't gone away.
It's a powerful long-term secular force that continues to gain momentum, even if it's not always front-page news right now.
Precisely.
Agreed. Okay, that brings us to our fifth and final essential question from the report. What's the deal with deal-making? Wall Street had pretty high hopes for an immediate boom in M&A and IPOs after the U.S. election last year, didn't they?
They definitely did. The capital markets subsector, which includes investment banks and asset managers involved in deal-making, actually rallied about 10% from election night until the end of January.
Doubled the market's rally.
Yeah, doubled the broad markets rally.
Yeah.
But those high hopes quickly ran into the reality of all the uncertainty we've discussed. Tariff concerns, still elevated interest rates, choppy equity markets,
Right.
which particularly slowed public market activity like IPOs. The window wasn't quite as open as people thought.
So the report notes that earlier expectations for completed U.S. M&A activity growth this year have been significantly revised down.
Yeah, revised down pretty sharply, from maybe 25% growth expectations earlier to now just 7% growth.
Only 7%. That's a big cut.
It is. But despite the lowered overall expectations, there are definitely green shoots, as the source called them.
Okay, some positive signs.
Yeah, global M&A activity was actually up 17% year over year in the first quarter, driven significantly by sponsor-backed deals, which are, private equity related.
Ah, so PE is still active. The report also discusses the uncertainty introduced by the new leadership at the Federal Trade Commission, the FTC.
Right. The new chair, Andrew Ferguson, has kept the previous administration's merger guidelines, but seems to be shifting the focus maybe more towards consumer welfare rather than just market share imbalances.
A subtle shift, perhaps.
Could be, though an adversarial stance on big tech seems likely to continue regardless.
Right. Now, what's particularly interesting in the private equity space is this balancing act that's been happening in the ecosystem.
Yeah, this is important context. For investors in private equity funds, the flow of capital was negative in 2022 and 2023.
Meaning more money going in than coming out.
Exactly.
Hmm.
Managers were calling for more committed money, capital calls, than they were returning to investors' distributions from selling assets. But in 2024, capital calls were essentially flat with distributions,
Okay, leveling off.
signaling a better balance and potentially freeing up some capital for new activity.
And this slower pace of traditional exits like IPOs or strategic M&A, along with private equity portfolios holding aging assets that need to be sold eventually. This is creating specific opportunities in certain areas of the private markets, according to the source.
That's the idea. One such area they highlight is secondaries.
Okay, explain secondaries quickly.
This is where investors buy existing stakes in private funds, or sometimes directly in private companies, from other investors who want to sell before the fund fully liquidates, rather than investing directly into new funds.
Got it. Buying existing positions, what are the benefits?
Well, the report highlights several. It can help mitigate the J-curve effect, that typical pattern of early negative returns in traditional private equity funds due to fees and investment timing.
Right, you skipped the early years.
Potentially, yeah. Secondaries often provide more visibility into the underlying assets you're buying, so less blind pool risk. And they offer diversification across vintage years, meaning the year the original fund was raised.
Okay.
And liquidity needs from large investors, like, say, college endowments wanting to rebalance, are also seen as potential catalysts for increased activity in the secondaries market right now.
Makes sense. Another significant development in the private market landscape they mention is the growth of evergreen funds.
Yeah, these are really interesting evolving fund structures. They offer investors more liquidity options compared to traditional closed-end private funds where your money is locked up for many, many years.
More flexibility for the investor.
Exactly. They
Yeah.
currently make up only about 5% of the private markets, but are estimated to grow significantly, perhaps to 20% in the next decade.
20%. That's substantial growth.
It is. And the report notes that over 4,500 clients invested in evergreen structures for the first time this year alone, which indicates growing investor interest in this model.
Wow, okay. And this evolution in private market structures is happening alongside that broader, persistent trend of companies just staying private for much longer.
Yeah, that trend continues. The median age of a company going public is now almost 14 years,
14 years.
up from less than 11 years just a decade ago. And here's a really striking statistic from the source. 87% of U.S. companies with over $100 million in annual revenue are still private.
87%, that's incredible.
It really underscores why exposure to private markets is becoming increasingly critical for investors to ensure they have proper exposure to the total economy, not just the shrinking public slice of it.
Absolutely. And finally, the report calls out a specific, maybe unexpected bright spot in deal-making: sports investment.
Yeah, this is a cool niche. Deals in the professional sports ecosystem, teams, leagues, related media infrastructure, they're growing in both number and volume.
Any examples?
They mention specific examples like the Boston Celtics transaction setting a record valuation for an NBA franchise, and Peyton Manning's Omaha Productions recently valued at over $800 million.
Wow, big numbers in sports media, too.
Yeah. This niche area is seen as offering opportunities for less correlated return streams through both debt and equity investments. Something different.
Interesting. So the conclusion on deal making is that while the overall landscape is maybe mixed compared to those earlier high expectations,
Right.
the private markets are evolving significantly in response. They're presenting new opportunities through structures like secondaries and evergreen funds, driven partly by that trend of companies staying private longer.
Exactly. And even specific growing niche areas like sports investment are becoming notable deal-making spaces. It requires careful consideration of the different structures and where the real opportunities are emerging in this environment. It's definitely not business as usual.
Okay, wow. We've done it. We've navigated through the 5 essential questions from this mid-year outlook report. We started by acknowledging that current market climate, where uncertainty feels, well, pervasive, and many of us are feeling that sense of being comfortably uncomfortable.
And the source definitely confirms that uncertainty is very real right now. But the core message, I think, the key takeaway, isn't that you need to somehow eliminate the uncertainty because, let's face it, you can't.
Right, impossible.
But that you need to understand it and actively look for the opportunities it inevitably creates.
And that's really been the mission of this deep dive, to unpack these 5 questions and the insights from the source material so you have greater clarity on the key forces at play as we navigate the second half of 2025.
Yeah, and the report emphasizes that the most powerful way to find clarity and navigate volatility isn't necessarily about perfectly predicting the market.
Good luck with that.
Right. It's about defining the intent of your capital and truly understanding the context of your own wealth plan. Things like your risk capacity, your risk tolerance, your time horizon.
Because ultimately, having that knowledge and understanding these dynamics helps you make allocation decisions that are aligned with your specific goals, regardless of the day-to-day headlines.
Exactly.
And that knowledge can truly make you feel more comfortable being uncomfortable in this uncertain environment.
It empowers you to stay disciplined and focused on your long-term path, which is what really matters.
Well said. As we wrap up, here's maybe a final thought to consider, building on everything we've discussed from this source material. In a world where seemingly unrelated forces like proposed tariffs impacting tech stocks, bank deregulation potentially fueling loan growth, shifts in the US dollar affecting international investments, AI transforming productivity at a startling pace, and deal-making opportunities emerging in unexpected places like professional sports, are all playing out simultaneously and influencing each other. How does understanding this complex, interconnected, often contradictory interplay of forces change how you think about building a resilient plan for the long haul?
That's a great question to ponder. Because the future isn't about trying to predict one single outcome. It's about recognizing and navigating the dynamic interplay of all of these different powerful factors.